In Forex trading, a drawdown refers to the difference between the high point and low point of the balance in trading account. The difference in the balance indicates a loss due to losing trades. For example, if a trader has 10,000 in his account and loses 5,000, which is a 50% loss, it's known as a drawdown. There are 4 simple methods that traders can follow to minimize the drawdown rate. First, keeping the risk low. Maintaining 1% to 2% of risk on each trade will allow traders to recover even if they have 20 conservative losses. Second, losses persist, reduce risk. By reducing risk with each subsequent losses, traders can avoid crashing their account during a drawdown period. Third, limiting the drawdown. By setting a monthly drawdown of 5%, and if a trader reaches the 5%, he can stop trading for the remaining days and resume trading the following month. Fourth, take a break. Trading can be challenging, so traders may need to take a break if things are not going their way and figure out what went wrong. It is extremely important and valuable to set a stop loss when entering each trade. In that way, any drawdowns will be limited. It is advisable not to make any trading decisions based on emotion. Instead, focus on a strategy that allows you to manage risk by exiting trades early to minimize losses.